All right, and I think we're live. Hi, everyone. Welcome to the show. Welcome to the tonight's YouTube Live. Very excited to have here with me Daryl Brown, who was my first guest. We tried having you on, but the audio, I didn't have my tech solution sorted. But now you're back, you're here, and I'm so glad to have you on the show tonight.
I think I'm readable now. I think people can hear me now.
Yeah, hopefully that audio, if we can get like a
Awesome.
thumbs up from the chat, we'll get. But I think everything should be good to go. That I solved the tech problems, and really happy to have you on tonight, Daryl. Really, I think you do bring a lot of great expertise. Tonight we're going to be talking mostly about bonds, so that's going to be sort of the big focus is bonds and bonds ETFs and all those different things. And so I'm just wondering if you can just give a quick little background to the audience, just so they get a sense of your background, sort of on the financial side. And then from there, we can dig into the market overview. We'll just kind of look at what's happened in the markets last week and then jump into our conversation about bonds.
Sure. So currently, I wear a couple of hats. I work for the firm that I founded called You and Yours Financial. I'm also the director of portfolio strategies for Spring. Tim obviously knows I work with him and his clients. And before that, I worked for Sun Life Investment Management, and they have a huge fixed income portfolio managing money for life insurance companies, for pension funds, and I was on the investment management team doing research primarily on the energy and infrastructure sectors. So,
So we were
uh,
talking. This was like huge portfolios, like
yeah,
multi-billion-dollar portfolios.
yeah,
On
yeah,
the debt side, infrastructure and energy probably not. And that you've got a bit of an environmental sort of background or focus as well, because
yeah.
you also like. I get the sense that it wasn't the most fulfilling work. Doing bond rating, analysis on those sectors.
I mean, it's incredibly interesting work, especially at the time the pipeline sector, which about 8 to 10 years ago was very quietly getting into to issues around trying to expand capacity out of the oil sands. So, being at the forefront of what a lot of people saw a few years ago, which is the blow up of the issues around Keystone XL, even Enbridge's projects like Northern Gateway, those were
Yeah.
all kind of quietly brewing in the background. You could kind of see what was going to come a number of years ago. So it was super interesting from that standpoint. And I think the part that became a little bit frustrating is that you're in an institutional environment, and the sole focus is how to make money. There aren't broader considerations about climate risks or environmental concerns. We didn't really pay attention to that, and
Yeah.
that was something that was a huge interest to me. So that was kind of where my interest sort of started to wane. But before then, it was incredibly interesting.
And then from there, you also founded a cool little company that's a zero emission delivery service. Is that
Yeah.
right?
I did, which is going kind of nuts right now. But it's called the Drop Distribution. It's a zero carbon, zero emission distribution company here in Toronto. We operate on an urban consolidated basis, which means we basically aggregate a lot of deliveries from a number of different clients, and then we basically deliver to the east side of Toronto one day, and then the west side of Toronto the other day. And so
Amazing.
there's been a lot of interest as unfortunately retail storefronts have
Yeah.
been looking for other channels to get their product out. We've just been getting a lot of interest. So yeah, number of hats. That's an additional one that I've got,
So,
which is
so you're an eco entrepreneur. You're a fee for service financial planner. The arrangement that we've got that I sort of brought you on, expecting that before COVID hit, we were planning for the Green Living Show, and I was expecting to get just absolutely slammed by client demand. And so I
yeah,
sort of brought you on and kind of trained you up on the process that I've been using with clients, just to be able to have that overflow, so that if there were more clients that I could service, that I wouldn't have to turn them away or have a 6 month waiting list, that you were there able to help those people. And certainly I think that it's my hope that as you're learning more and exploring and having a lot of fun on the ESG side of things, that certainly I think there are a number of ways in which you're going to be a very busy man
Yeah.
over the next little bit. So I'm going to hope to grab as much of your time as I can. And so let's do a quick little market overview. What I've got up here, and everyone at home can see my screen. I've just got Yahoo Finance, but Daryl does not. I can't sort of effectively share my screen over this. So what I'm going to do is just kind of speak through it, and I'm going to open up the All Country World Index, and just to look at the chart, we can just look at it over the last 6 months, and it's quite remarkable. To see the crash happen and then an immediate bounce back. And then we have just been in this very slow, steady, I wouldn't even call it like an escalator up. I think it's like a treadmill that's just like angled up a little bit. But when you look at it over, really since the sort of the initial crash and then the rebound, it really has been this slow and steady increase. And I think that, you and I, Daryl, I think we've talked about this sort of over the course of this period. And I think we both tend to be very, very cautious. And I think that right now, my assessment of the situation is that whereas before, I was kind of talking about this idea of the bulls versus the bears, that, sort of the people, the optimists versus the pessimists, and that really there was a bit of a stalemate for a little while. I would say that at least now, like this week, over last week, the bulls have won, the optimists have won. And I would caution that really listening to experts and people that really are for that bull case of like, let's open up the economy, let's everything's back to COVID, whatever, mission accomplished, we're through it, wasn't a big deal. That I'm worried that it's kind of turned from optimism into hubris, like into just this sort of blind faith that everything's going to get better and that it's not as bad as it was, and that almost sort of maybe a little bit of gaslighting being done, and where really it's just there is still such a disconnect between the performance of the stock market and performance of the real economy. What's your take on that? What's your sense of where the emotions are right now?
They're in transition. I think they have gone from a place where I think people were buying based on the understanding that things were getting less bad. The terrible economic forecast was being taken off the table. That sounds kind of crazy to think that where we're at right now isn't terrible. But there was a certain point in time where investors were thinking that we would be in total lockdown for a couple of years. If you recall, when some of the first job prints started coming out of the U.S., I think it was -8 million. You actually had a fairly robust rally because people were thinking that it was going to be worse than that. Right. So we've transitioned from optimism around there being less bad to a situation where it's we're not really sure. And now there is excitement around the reopening of the economy, which I think is going to continue to support stock prices in the near term. I think that disconnect between what we're seeing on the employment side and what's happening in the market, part of that being explained away by central bank actions that have kind of helped support the economy in the near term. I think longer term, I think that's where you and I definitely are kind of sniffing around and really not sure kind of how things are going to go. But I think from an investment standpoint, what people are transitioning into right now is this belief that, and there's real buying out there, that the economy is going to reopen. We are going to have a restart. There's going to be some kind of spending and snapback. So, that's what I think's pushing the market forward now.
Totally. And I mean, we're seeing it in funny ways. One thing I saw this week was Royal Bank. A lot of the banks reported earnings. And, this was a good week for the banks. Like, I'm just showing the chart up here, but, Tuesday jump up, Wednesday jump up, really sort of held those gains throughout. That the banks had been sort of battered throughout all of this. And even though they, here it is, they set aside these record provisions for what the headline here from Bloomberg is Royal Bank BMO set aside record provisions for soured loans. So these are loan provisions. This is money that they're saying is that loans are going to be wiped off their books. So the Royal Bank comes out and says that $2.83 billion is just like they're just writing that off their balance sheets, and the stock has one of the best weeks it's had in a while. It's this idea that maybe things aren't going to be as bad as we thought they were. Yeah. And that does seem to be sort of the dominant emotion right now. And, I think it's just a really good time to be cautious for me, because I do talk about this broader dichotomy between greed and fear, and how I sort of like to be the opposite, that when people are greedy, I like to be cautious. And then when people are afraid, that's when I like to be a little more aggressive. So when we saw the big crash happen, right, before that, everyone was greedy, right? Like the good times were rolling. And that's when I think, bonds were really important. And, if we didn't have enough bonds in our portfolio, that's when the crash hit us harder than, it would have otherwise. Yeah. And that when everyone else was afraid, I mean, looking back, if we had the crystal ball, if we had the time machine, that would have been a great time to buy. A lot of my favorite stocks were down, substantially at that time. And then it did bounce back. I mean, good luck trying to time the bottom, of course. But, at one point we did sense that things were overblown, that fear was ruling the day. And that would have been the time to get greedy. And then now that things have come back up a little bit, I'm coming back to a place again of cautiousness, that I do see this confidence and frankly, this greed in the marketplace right now, which is why I do think it is a good time to rebalance. I hear you that there might be, support over the next, probably 3 months or so. But my understanding is that when, really it's these mortgages and a lot of these debt programs, there was sort of this 6-month grace period. And if we think like March, and then what is it? April, May, June, July, August, September, that really mid-September is when a lot of these things are going to be coming due. Now, there's a lot of time between now and then. And certainly if we get a vaccine, or if we get more good news, or if we get more supports, then it might be easy for them to, then kick the can another 6 months down the road, which could extend it. But the sense that I get is that the real impacts of this crisis, in terms of the unemployment and in terms of bankruptcies and in terms of, the impact on people's lives, that we're not going to see that for a little while. That is a bit of a lagging effect. So, who knows? And certainly we could see the stock market continue to rise. But I think that is why I wanted to really have you on this week to talk about bonds, that I think for regular investors, this is a good time to be able to do that rebalancing, make sure that your bond levels are at an appropriate level, which then really sort of, begs the question, should our bonds still, the option, is this still the way to do it? Do all the old rules that we had before the crisis, do they still apply right now? So that's what we're going to get into. Thank you. Someone just joined. Miss Don't Try This at Home says, I'm late, but I'm here. So welcome to the stream. So happy to have you join us. So before, I just want to touch on 2 quick things for my market overview. These are just things I tend to show every week. So the first thing is the VIX, the volatility index, to get a sense of how volatile markets are right now. We can see that it has continued this sort of downward trend, that, we are seeing less volatility. I mean, today the Toronto Stock Exchange was down 0.06%, which is about as flat as you can get, which makes me very happy on the volatility side. So that makes me happy. And then I do like keeping a quick look on the oil price. So for WTI, West Texas Intermediate, it has bounced back from the lows. We're looking at about $33 a barrel. So, really there was, that weird crash that we saw with the ETF, and where I had that video, WTF happened to oil prices. That hasn't been repeated. The futures market didn't collapse once again this year, and or this month rather, and that once again, oil has come back up, as is Western Canadian Select, which is the Alberta oil, which, I gotta say, obviously, I don't have a lot of sort of sympathy for the CEOs and the investors in the oil sands, but certainly a lot of employees there, a lot of companies, small businesses that I know depend on that sector. So, they're gonna be a little bit happy just to see that the price isn't, at the $5 a barrel where it was for a little while, that it has come up to about $26 a barrel, which does speak to the, this idea idea, this optimism that it's going to be, the economy is going to be opening back up. That, you know, maybe the airlines, whereas before that, you know, it was down 90%, maybe now it's only down, you know, 50%. That, you know, things do seem to be improving. Although, you know, I think that there's understanding, speaking to a lot of medical experts, that, you know, there is reason for caution still on the biological side of things. Anything you want to add there, Daryl, or does that feel pretty good?
No, I mean, I think we both kind of have been looking at, you know, kind of the economy, the real economy in tandem with how markets are doing. And I think for both of us, even coming into this crisis, I think the key thing that we've been communicating to people and that we've always kept in mind is the importance of rebalancing your portfolio. It's just something that has always kind of worked. Of the investment rules that are out there, there are very few that you can kind of say time and time and again through numerous different phases of the economy, of the economic cycle that work. That is one of them. So, you know, we did see people kind of coming into the crisis that they were a little bit too hot in terms of their allocations, too much equity, not enough bonds in their portfolio. You know, the crisis kind of effectively rebalanced their portfolio for them because those equities start to fall off. So it's something that is always important. It's always something that I recommend for clients when they're looking at their portfolios, and it's going to continue to be forward, irrespective of, you know, what the outlook is at the moment. It's always important to just keep that in mind, and it's something that, you know, each person has to understand for their own personal risk tolerance.
Absolutely. My mantra throughout the entire crisis was keep calm and rebalance. And, you know, I think that applies in times of fear as well as in times of greed. That really, you know, and I would say we're starting to touch on that greed a little bit more. So Shantanu checking in from Ottawa. Thank you so much for joining. Really happy to have you here. Love Ottawa so much. So happy you can join us tonight. So, okay, so let's shift the conversation to bonds. You know, really when it comes to bonds, there are a wide range of options. You know, but the standard benchmark that we tend to use in a lot of these sort of couch potato portfolios is something like XBB. So I'm just going to bring up XBB, which is the iShares Core Canadian Universe Bond Index ETF. This would be a very standard part of your bond portfolio. And so, like, my first question, Daryl, is that, you know, traditionally we would say we kind of had this view that this general rule that the bonds should be the percentage, or sorry, that the percentage of bonds inside your portfolio should be consistent with your age. So, right. You know, I'll speak for myself, right? I'm going to have to do the math now. I'm turning, 38. So I'm 37 years old now. And 2020 makes it easier for me to do the math there. And so roughly, as a general rule, I should be at about 37% bonds. That would put me at 63% stocks. Now, obviously, there's some wiggle room there that I can look at my risk profile that, you know, on the one hand, I'm an entrepreneur, so, you know, my risk is a little volatile. I don't have a huge amount of insurance, you know, because I run my own business. So, you know, a little bit, maybe take a little bit less risk there. On the other hand, you know, I am engaged. So, you know, my fiance is, you know, does have a nice stable job, and that it looks like there will be some benefits and insurance coming through with that. So, you know, it's the type of thing where I would be able to sort of keep myself in a range. I would say the lowest I would go if I wanted to be very risky, but really the lowest I would go, it would be about 30 or 25%, you know, 25 to 30. That would be the low end. You know, at the high end, if I wanted to be more risk adverse, probably about 45. I don't think there's any sense for me to be more than 50% bonds in my portfolio, but, you know, really depending on that risk profile. You know, that was the rule for so long. The issue is that right now bond yields are just so low that when I look at interest rates, like here I am on XBB, this would be a standard bond ETF, and I'm looking at the weighted average yield to maturity, which granted is like a low ball estimate of what I would expect to earn on this bond ETF, but I'm looking at 1.5%. So, you know, it's just a bit of a tough pill to swallow to think that, you know, 37% of my portfolio should be in something where really I only really expect to earn 1.5%. So help me understand why this is still a good idea.
So a couple of things. When we talk and when we communicate with clients about asset allocations. I think you described it really well. It's not meant to be hyper prescriptive and strict. So if you decide you want a 65-35 portfolio, doesn't mean you have to rebalance it to those exact amounts every single day, every single week. There are ranges, and I think those are healthy to have. 5%, 8%, 10% on either side. Those make a lot of sense. Now, going back to the point about interest rates and bonds, the rates are low now. Coming into 2020, the rates on the 10-year Canadian bond were 1.5%, and I thought those were extremely low. We're at 0.5% right now.
It couldn't go any lower, Daryl.
Right?
It couldn't go any lower.
That's what I said. That's what I thought at the beginning of 2020. Yeah. But you know what? That was said in 2016, and by large institutional investors who do it for a living, who manage large sums of money. And it was said also in 2013, and it was said in 2011. Like, you get the picture. Like, there have been so many points along the way where people have gone, oh my God, bonds are a joke. Why would you ever have it in your portfolio? They don't make any sense. They're not going to make any money. And there's two components to earning a return on your fixed income or your bond investments. Number one is the interest rate, which at times could appear low, whether it's 3 or 4 or 2%, whatever it is. That only comprises one part of your total return for a bond. The other part is the fact that your bond price can actually increase over time. When I started working on the institutional desk and I opened up the portfolio, there were bonds in there that had appreciated 60%, 60, from when they were purchased. These are long-term bonds, which coupons, and because interest rates had declined so much, the bond prices have gone up. And so for people who aren't aware of the relationship between interest rates and bonds, interest rates go down, the price of bonds goes up.
That's right. So let's just break that down. I just because it's a tricky concept and it's a really important one, is that the idea here is that the value of a bond versus the interest rate. So if I buy a 10-year Government of Ontario bond that earns, I don't know, I'm just going to say 2% a year, that if interest rates go up, all of a sudden, my 2% isn't, that someone could buy that same bond now and earn, let's say, 2.5%. Right? So all of a sudden, my bond that's only paying 2% isn't worth as much. Sell it, I would be selling it at a discount in that case. So the value of my bond goes down as the interest rate went up. And the flip side is true, that if my 2%, 10-year government bond, if interest rates fall even further, all of a sudden my 2% is like awesome, like I'm getting 2%, it's worth more. It starts trading at a premium.
People pay a premium. Yeah.
So, helping people understand that, there is that little difference. And I had XBB up, here, and I can just show people just that it was up. Where was it? I had it here. The year to January 1st, this very traditional bond ETF is up 5.5%. So when the stock market, with the stock market down, the value of our bond ETF is higher. So really it is that what we would call a negative correlation. So if I just chart over the last 6 months, XBB, and I'm going to compare it to, I've been using XAW.to lately as my sort of benchmark in Canadian dollars. This is the MSCI All Country World Index, but minus Canada. There isn't one that's like includes Canada. So this is the one that I tend to have here. And, let me do it for a year, because I think that'll tell the story. That basically, as the stock market had been doing well, the bond was flat, and if not, actually down a little bit. Now, not the interest rate. This is the share price of the bond. Okay? So this isn't the interest rate that we're getting. This is if I wanted to sell my bond. As it went up, the value of my bond was down. Now, there are some interesting points where, they both did go up a little bit, just before the crash, but it was really once the crash started, that's when the value of our bonds actually went up. Now, there was a very, very scary moment. And this was, I've got it here, and this was March 18th. And this was the moment when our bonds came down as well as the stocks crashed. And I see you nodding because I think you remember this week in March, because we were all sort of collectively holding our breaths, because this was a very bad signal that stocks and bonds both falling at the same time. Now, obviously, bonds didn't fall by as much, but they did fall quite a bit. That's when we had this government intervention, and not so much by governments, but from central banks. So, here in Canada, we have the Bank of Canada. It really was in the US, the Federal Reserve, that they moved much more quickly than they did in 2009. And they started buying bonds. And literally the Federal Reserve, the organization in the US that is essentially allowed to print money. I'm using air quotes for print because it's all electronic now, but they're able to snap their fingers and create money out of thin air. And they use that cash to inject it in the bond market to be able to have that liquidity, which meant that bonds came back up as people got more confident, while stocks did come back up as well during that bounce up. So again, they did sort of move in tandem there for a while as well. Now we're at a bit of a funny point, I think, in my mind, because really what it comes down to is the risk around bonds. And I'm going to split it up a little bit because I want to talk about corporate bonds and I want to talk about government bonds. And just so that people know that this XBB, this standard one, this is a mix of both government and corporate bonds. So I can show you the breakdown by sector. It's about 37%, 33%, or 34% federal, and then the rest. So about 70%, 71% government, and then about 29% corporate. And so that, when we look at the difference, in my mind, these are sort of two separate areas that I think coming out of this, we should talk about them a little bit differently. And so, in terms of the corporate bond market, Daryl, what is your sense, what is your feeling around corporate bonds right now?
So I think the good news for the majority of the indexes that appear in bond ETFs, we're talking about fairly well-rated and good quality bonds. They're not high yield bonds, which are, or in other words, junk bonds, which have below investment grade ratings. But
okay, now I need to stop you just because I want to break this down, and I've got it on the screen because you're using some terms here. So in terms of these credit ratings, we do, and I've got the breakdown here within this ETF. AAA would be your highest rated. This would be your Government of Canada, safe. If this goes down, we've got bigger fish to fry. And really, am I right in assuming that I think with this credit score, it really is about the default risk, the risk that the organization is going to go bankrupt and default on their debt, because this bond is like debt. I'm loaning money to these government and corporations, so that this kind of assesses their likelihood of going bankrupt. Is that right?
That's right. Right. Absolutely. And so when you're looking through the actual holdings of these bond ETFs, the corporations in there, in addition to the governments, the probability of default for them is very low, or in other words, they have a very high credit rating. So,
and let me just, forgive me, but just a high credit rating. So the lowest it goes here is BBB. So AAA safe is AA, single A, triple B, and then I think I'm right in thinking that triple B, that's the lowest score to be considered investment grade, and that's a very specific expression. And what this means is that they kind of count as this thing called tier 1 capital, so that when federal banks or federally regulated banks need to have a certain amount of what's called safe debt on their books, and that a lot of these foundations and pensions and big pools, they're not allowed to own bonds that have a below triple B rating. And so when a bond has a double B or a single A, or I think triple C is the lowest, I think, that those are considered junk bonds. And for a long time, there's the junk bond market, because they're so risk, they have to have a higher return, that investors demand a higher interest rate. And so it's been interesting to see the industry kind of spin it, and instead of calling them junk bonds, it's no, these are high yield bonds because they have a high interest rate. But the reason they have a high interest rate is because they also have a high risk profile.
That's right.
So what you're telling me here is that inside this, because it's all investment grade, because triple B is the lowest it'll go, in terms of this bond ETF, that this is considered a fairly safe, investment. Now, I want to come back to a point you made earlier, which is that when you were working in the industry, they weren't really looking at ESG factors. And so, am I safe in assuming that some of the companies that are in here that are triple B, They might be triple B by one measure, but for us, if we're looking at it through this ESG lens, there might actually be more risk there. Does that seem plausible?
Yeah, absolutely. If you layer on ESG scoring and ESG factors, there are companies that are included in some of those ETFs that, for either values reasons or because you just factor them in and that you believe that the risk is significantly higher,
Yeah.
that you would not want in your portfolio.
So, and I'm just going to
Very
show
good point.
people this list just so that they can see. And again, this is sort of like XAB. So we get a lot of government bonds. I'm just going to sort it by sector. And so under communications, Shaw, Rogers, Bell, TELUS, again, all sort of investment grade big banks here. And then really it's when we do get into the energy sector that we start to see TransCanada pipelines, TransCanada, Enbridge, Suncor Energy. So, it's not going to be the lowest risk, but there definitely are pipelines in here. Husky Energy is in here. Obviously a lot of tar sands, a lot of pipelines. And so to me, this is kind of the big red flag here. And that now it's not a huge part of this portfolio. If we do look at the sector breakdown, energy is about 5.8%. Right? So not a huge amount, but it is in there. So obviously for ethical reasons and for risk reasons, it probably makes sense for people to consider there are now ESG bond ETFs. So if you did want that mix of government and corporate bonds, something like XSAB, which, year to date up 5.5%, almost exactly the same. The weighted average yield to maturity, 1.45%, still so low. But it is going to provide that sort of negative correlation, and that when we look at the sector breakdown, it's going to have a much lower percentage, only about 3.5% allocated to energy. So it still has pipelines in here, but it is going to get rid of anything with a low ESG score. And we'll kind of talk about it in a bit, that there is a cool new tool that we can look at these in terms of the ESG scores for these ETFs. But this would be an example of something that is both, if you did want some exposure to corporate bonds. Now, like in your mind, this idea of like 70% corporate, 30% corporate, 70% government, like, does that still make sense? Like, if corporate bonds, we're assuming that these are going to be the higher risk or the lower risk ones, the higher rated ones, a little bit safer, that there is this government support from the central banks that is sort of like propping them up a little bit. That said, I think, really government bonds are going to be safer during this time. They are going to have a lower interest rate because they are safer. But like in your mind, and like if I can ask, like with your money, are you someone that would definitely have a mix of corporate and government bonds? And is this 70-30 measure sort of appropriate in your mind?
I think it's going to depend on each person. For me, understanding the dynamics of the corporate bond market, I generally feel a little bit more comfortable with that type of mix. But right now, that you're bang on with the trend, and I think there's a lot of what's called flight to quality out there. So there's a lot of interest in purchasing really, really high quality bonds. Government of Ontario, sorry, province of Ontario, province of Quebec. Government of Canada bonds and the related issuers around there. They're all really, really highly rated debt issuing entities. So,
Totally.
I think there's a lot of support for those bonds out there. That said, the interest you'll see it in the sense that those higher quality bonds have generally slightly lower interest rates attached to them.
Yeah.
So there's always a little bit of a trade-off.
And so just to show people, if I look at XGB, which isn't the cheapest one on the market, but these are all iShares, so it's kind of nice that like the layout's the same. We can see that just government bonds have actually rebounded more. So the government bond ETF up 6.69% instead of 5.5%. So it tells me the government bonds sort of rebounded a little bit higher. I think this would reflect to what you said, sort of that flight to safety. And then, but the weighted average yield to maturity only 1.13%. So, this is going to be just government bonds. This is, you can see here, just provincial, federal, a little bit of municipal, very high credit rating, 51% AAA, 43% AA, so less single A, no triple B. So these are going to be safer. That they have actually outperformed so far this year during the crash with this sort of, flight to safety on the bond side, but you are giving up that interest rate. So, I think everyone's going to have their own thing there. Did get a question from Steve, and I just want to recognize from the chat that there was a question from Gail. And Gail, I'll get to you with these stock ETFs. We can get to that in the Q&A a little bit after the bond discussion. And June, I'm so glad that you're happy with that interest rate and bond value explanation. I know that's one that people often get stuck with, so hopefully that's clear. So Steve's asking, are there rules of thumb or recommendations for diversifying within a portfolio bonds allocation? In terms of corporate versus government, I think what I'm hearing from you is that, probably makes sense to lean more towards government. That 50-50 would be a fine way of doing it. But, if you're starting to move more on the corporate side, you are taking on a little more risk. And so recognizing that. And then in terms of long-term versus short-term, I want to bring up the maturity. So let me just explain this concept first. That, when we buy a bond, it does have a very specific maturity date. So if I'm buying a 10-year bond that's giving me 2% per year from the government of Ontario, I'm going to hold it for 10 years. And at the end of 10 years, I get my money back. That bond matures. And the idea is that I would then need to reinvest that money. So at any point, any bond is going to have a specific maturity date. And that there's a good chance that when we're looking at it, that unless it just got issued, that we're part way through that duration. And so we're often looking at how long is left on that bond until it matures. And so with all of these bonds, the ETFs that I've been looking at, and again, so the bonds inside are sort of like locked in, like it's like 10 years and there is that 10-year term. But with ETFs, because they're so liquid, you can buy and sell them whenever you want. There's no lock-in, but the bonds that the ETF holds, each bond is going to have a maturity. So this is the breakdown, 13% within the next 2 years, 9% 2 to 3 years, 17% 3 to 5 years, and then all the way up to about 24% of the portfolio is 20 plus years. So all of these bond ETFs are a mix of short-term, medium-term, and long-term bonds. My opinion has always been that, diversification is a good idea. That if I had really strong feelings about interest rates and which way interest rates were going to go, and I could get in the head of the governor of the Bank of Canada and consult that crystal ball, that, if I thought interest rates would go up, then I would want a shorter duration bond, because then it would mature faster, and then so I could reinvest it at a higher rate. If I thought interest rates were going to go down, then I would want a longer term bond, because then it's going to be more valuable because interest rates are lower. I'm glad I bought it when interest rates were still high. But personally, I'm of the opinion I don't really want to spend my time guessing interest rates. So I tend to prefer a mix of short-term, medium-term, and long-term bonds, and a nice sort of healthy mix of those three. Daryl, do you have any input on that? Are there these sort of rules of thumb in terms of short-term, medium-term, long-term?
Diversification. I think trying to pinpoint, kind of where interest rates might be going, and then selecting a duration strategy based on that. You might as well flip a coin. So I prefer, exactly as you're mentioning, just having a diversified approach where you do have some short-term bonds, you do have some long-term bonds in there. Awesome. It's really, I think, a impossible strategy for not just retail investors, but even for institutional investors out there to really have a good prediction of which way interest rates will go. So just having a mix, I think, spread it around and have a mix between both corporate and government bonds in your portfolio.
And in my mind, it's not a big deal if you just can't stand owning pipelines. Even in this ESG one, I can show you here. If I look at the holdings, there is still going to be pipelines in here, right? And these would be the higher ESG pipelines, right? And so, to me, it's if I look, let me just get it here, PepsiCo, TELUS, Hydro One, but here it is, TransCanada Pipelines, there it is. So there are going to be some pipelines in here. So to me, really, if this is a thumbs down, no, I don't want any. Unfortunately, with these ESG funds I haven't seen a fossil fuel free bond ETF, corporate bond ETF yet. So, so to me, it's just the solution. If you really don't want pipelines or any fossil fuels, do just government bonds. And I think, Daryl, we're on the same page that, that would be playing it a little more safe than you need to. However, in this environment with everything that's going on, that should be fine. Is there any concern around like long-term like deficits and debt with governments? Like obviously they're spending all this money right now. Like, is this something that we should be worried about at all?
In the near term, no. I think there was probably a little bit of a conversation as the crisis was unfolding. Okay, well, debt to GDP for any of these sovereign or sub-sovereign nations is exploding. That said, the interest rate to service any of this debt being issued is incredibly low. So any of these
Yeah.
provinces or governments out there are able to issue debt to basically support the economy in the near term, and the interest rate that they're paying
Yeah.
is in the kind of zero point 0.4, zero point 0.6. I think the long on the 30-year government of Canada bond, we're at about 1% right now. They're
Right.
extremely low. So I think a lot of people get caught up on looking at the debt to GDP metric,
Yeah.
the full amount of the debt compared to what's the economic activity. That is one measure to look at deficits and fiscal spending and ratings. The other aspect is also looking at the amount to service that debt.
So the
And right
interest
now,
payment.
interest payment is extremely low right now.
And so right now with this low interest rates, it's bad news for investors. We're all grumbling at our low returns, but
Yeah.
it's good news for taxpayers knowing that, now this could be a time to implement like a Green New Deal or obviously the social programs that we have right now. This notion of how are we going to pay for it? It's like, well, interest rates are so low that like now really is the time to invest in the future, both in terms of people and the planet. So I think that's good. Did get another question from Steve. He said, very helpful. Thank you. Would it be safe to say that for an average DIY investor, an ETF that covers the universe of bonds would provide adequate diversification? So these are going to be like this like aggregate universe. When we look at the iShares, this Canadian universe, these are kind of the standard benchmarks, I think is what Steve is referring to here. And, in my mind, yeah, like this is why they exist. That's kind of why they call them universe, that this really one ETF is really the only thing you need. And it's a matter of just picking what is that one ETF. It has popped up before, and Daryl, I'd love your opinion. The idea of diversifying into international bonds, like with our stocks, we want to be globally diversified. That's kind of a no-brainer. But when it comes to our bonds, we're not. We tend to really stick in Canada. Can you speak to that?
There's a bit of an interest rate risk component to it. When you're invested in global bonds, you are subject to interest rates kind of on a wider basis, which is a good thing. And I think with globally diversified portfolios, it's a nice complement. Flip side to that is you also do have a little bit more exchange rate risk with some of these more global bond portfolios. So, it's a good thing. Just be aware that there are both Canadian dollar hedged and unhedged ETFs out there. We do find, and there is the tendency for corporate bond ETFs and lots of portfolios that I looked at for them to be Canadian centric.
Yeah.
So that's on the one hand, it does provide a level of support in the sense that you don't have this additional exchange rate risk embedded in there. But on the other hand, you are kind of stuck with the same sort of set of companies. Will be your financials, kind of pipelines, telecoms, and government agencies in the portfolio.
Well, I mean, and there are some let me just see if I can bring it up here. But there are some, for example, there is a green bond ETF, but the issue is that it's international and it does trade in US dollars. And like, just to give people an idea, the yield is like 2%. And, if I were to look it up, this GRNB, let me just do a summary, GRNB, that year to date, it's probably up, a little bit, but it is the type of thing where, because it's traded in US dollars, really the difference, what's happened in the gap between the Canadian dollar and US dollar, in my mind, would like dwarf all of the returns in terms of both the interest rate and that appreciation. So now in this case, it would have been good if you bought a US dollar bond ETF, having that currency risk. Well, guess what? The US dollar got stronger, the Canadian dollar got weaker. You would have won there. You might have almost like doubled up on your returns. But it's almost a coin toss that we don't know what's going to happen with exchange rates. That if the opposite happens and the Canadian dollar gets stronger and the US dollar gets weaker, that now all of a sudden we're in a situation where, any return we have from our bond ETF has just been wiped out because of that currency exchange risk. So, in my mind, it is really a good idea just to keep it with Canadian dollars. If you did want to carve out like a small part of your bond portfolio for, US dollar corporate ETFs, there are a couple of ESG options there, or, something like a global green bond ETF. It's kind of a nice to have, not a need to have. And I would say that for most people it really doesn't matter that certainly you don't need to do that. It would only be something if you really wanted to do it and you were okay taking that currency risk for this very low risk part of your portfolio. Do I have that right?
I would say so. Yeah.
Awesome.
Definitely.
Cool. Well, I feel really good about this. I think this was a great conversation about bonds, digging into the ETFs. Just want to throw it out to the chat. If you do have any more questions, happy to sort of stick to this topic. Otherwise, what I want to do, there is a little bit of a tool, a new thing that came out this week that I did want to show you that we can play with a little bit in terms of evaluating ETFs on the ESG side of things. So there's a new tool there. And then, Daryl, I think you're happy to stick around. Is that right?
For sure. Absolutely.
Amazing. So I'm not seeing any questions from the chat, so I think we're good in terms of the bond side. Oh, there was one last thing that someone had asked that I wanted to bring up, which is bond ETFs versus high interest savings accounts. This is something that with these bond interest rates so low right now, some people are like, Tim, should I just keep it in cash? My sense on that is that, it's really a coin toss, that if you can have one of these high interest savings account that's paying you 2% or whatever, sure. But the issue is that with the bonds, with the cash account, that you're not getting that inverse relationship, that inverse correlation to stocks. So if there is another crash, your cash isn't going to be worth more. It's not going to go up in value at all. And then also there is going to be the fact that you're going to have to transfer the money into your online brokerage account. So, if your money is already in Questrade or Qtrade or whatever, then you're not going to want to pull it out and pay a fee to move it over to this other institution and then pay a fee to move it back over into the online brokerage. So, there's sort of that element. And that also there are these high interest savings ETFs. So there's C-Save is one, and the other one is PSA. ETF, and these are high interest savings ETFs, and the rates on these are just so low right now. C-Save, when I look at it, 0.75%, right? And then there is a little management fee of 0.14, so you're getting 0.6% on the net. PSA, which is from Purpose Investments, kind of the same thing, 0.65, and the management fee of 0.15, so we're only getting 0.5%. So, my sense is that if your money is in a high interest savings account, maybe leave it there until you're ready to invest it. You're going to have to transfer it at some point, but you might as well leave it. But otherwise, if your money's already in an investment account, you probably are better off with a bond ETF rather than one of these high interest savings ETFs, just because that interest rate, will still be a little bit higher, even though they're both really low. And you will get that added diversification, that sort of buffer that, if there is another crash, we would expect, interest rates to drop even more. They might even go negative. Who knows? Well, that would be a fascinating conversation to talk about negative interest rates, but it could happen. And of course, that would push the value of our bonds up. So, Daryl, any thoughts? Do I have that right? Are there any thoughts on this sort of high interest savings versus a bond ETF conversation?
Only the one other thing that I would add, and I've kind of been saying this for a couple of years now, shockingly, is that GICs are still they're actually kind of in right now. They're not too bad at, for 2 years or 3 years, you're in the 2% range.
Yeah.
Benefit with a product like a GIC is that you can have this type of static return in your investment account. With a high interest savings account, it's a little bit kind of cumbersome to have it off to the side. I think high interest savings accounts are great to park money for emergency expenses, to have it on the side, which I actually didn't get on my kind of pro have your emergency expense 3 months, 6 months, whatever spiel. But GICs, high interest savings account, and just plain old bond ETFs, they all have a place. I think they're all really good options. And they do things slightly differently. But I would definitely say that there's no major advantage to one versus the other. Like you said, if we start to get interest rates that slide even further, which is definitely possible, your corporate bond or your government bond ETF is actually going to give you your existing interest rate plus a bit of appreciation, whereas something like a GIC or a high interest savings account won't.
Yeah.
So there is that negative. That said, if the converse happens, if rates start to go up, your corporate bond or government bond ETF is going to have a little bit of a drag on the total return,
Right.
because the prices for those bonds will start to perhaps erode a little bit, like we mentioned earlier. So there's a little bit of, again, it doesn't not a cop out. Just talking about diversification and the importance of having different products and different strategies in your portfolio.
And so, my understanding is that GICs and high interest savings accounts, those would be considered uncorrelated to the markets. Right. That they're just not going to budge no matter what the stock market does. They're just going to keep humming along. Whereas, the bonds, the reason we like having them is that negative correlation, that they're going to go in the other direction. I do have a website up here. I don't know where you shop around for GICs, Daryl's. I've got this highinterestsavings.ca/GIC rates, and that tends to be pretty good, but like People's Trust, a 1 year 2.1%, 2 year 220, 3 year 230, 4 year 230, 5 year 240. So, you do get a bit of a premium by having a longer duration on it, but that would mean that, the risk of sort of interest rates going up, and, that obviously there would be a better place for your money if you did that. So, I would like the idea of sort of sticking probably to 1 year GICs for now. And, and then maybe even like, if you wanted to do it over the longer term, you could like build a ladder. So you could, sort of do like, 10 or 20% of your money into the 5 year, and then just do that every year for 5 years. And then that way, part of your money would come due every single year. So, these are different ideas, in terms of that very low risk part of your portfolio. But really, I think the takeaway here is that whether it's a bond ETF or a high interest savings account or GICs, that really it is still important to have that as part of your portfolio. I would say at this moment in time, for sure, just as the market does, get more confident, and the stock market does go up, and that really it's a bit of a, personal preference between those three different vehicles to figure out what's the best thing for you for that low risk part of your portfolio. Perfect. Okay, cool. So let's switch gears now. I want to bring up this. I'm going to bring up this MSCI tool. So MSCI, as a lot of people know, this is a leader when it comes to ESG ratings. And I had been playing around with, I think it was a week or two ago, the ESG rating. So these were looking at individual companies, and we can look up individual companies like Apple is usually the one that I get. And so you can see it here has a single A rating. Well, now what's really cool is that MSCI just launched this past week their ESG fund rating page for free. So it's a little bit awkward. The Google algorithms haven't really picked it up yet. So it's not something you can really Google too much, but it's msci.com/ESG-fund-ratings. And you should be able to bring it up. And what's cool is that this allows us to look up ETFs. And so I've got here XBB, which is our iShares Core Canadian Universe Bond Index ETF. This is our run-of-the-mill bond ETF. I can get here that overall it has a rating of A. We can see the distribution, that it does have mostly these AA, single A and AA bonds, a little bit of AAA, and then there is a tiny little bit of single B, right? So these would be the things I would be the most cautious about. It gives us the weighted average carbon intensity, which is the CO2 per $1 million invested, which this is kind of going to be my standard benchmark for carbon footprint. As well, it does give us a breakdown of green versus brown revenue. So this is interesting, which is, the green revenue is going to be alternative energy versus brown revenue, which is thermal coal. So you can see this does have brown revenues in here, 0.7%, a little bit of coal, but it also has some green revenues in here as well. So it's kind of cool to be able to see the sort of doing less evil versus doing more good on the same page. As well, it is going to tell us the board independence and the board diversity, which to me is pretty cool that we get those breakdowns. And then it will list if there are any major controversies. So I can see here that there are 5 UNGC. So this is the UN Global Compact, right? And so there are 5 violations, but it's only about 0.1% of the portfolio. and there are some very severe controversies. So these would be major red flags. Again, it might be the same 5 companies at 0.1% of the portfolio. So, because this ETF doesn't have any screens, you can see that it doesn't surprise me that a few things are going to squeak through here. And so what's cool is that now what I can do is compare it to the ESG one we looked at, which is XSAB, that this is now the ESG fund. And you can see right away, instead of single A, it's got a double A rating. You can see it's gotten rid of anything below triple B on the ESG side. So it's going to be mostly double A and more triple A, and fewer single A and only a tiny little bit of triple B. So it is going to be much better on the ESG side. It's interesting, the weighted average carbon intensity is about the same, 151. Let me just go see if I can, sorry, I have to search it here again. XG or XBB. I just want to see if the number is different. It was 197, and so it does come down, SAB. It's just tricky because it's still considered moderate, but it is down to 158. So it does lower the carbon footprint. A little bit less brown revenues. Again, there are still some pipelines. It's not what I would consider fossil fuel free, 0.4. But look at this, a lot more green revenues, right? And I'm not surprised that it would have a higher exposure to companies that are in the alternative energy space. So 1.4%. Board independence is good. Board diversity is better, but still not great. Board diversity, this is going to be a percentage of women on the board of directors, is so bad in Canada that even in an ESG fund, it's only at 39.2%. So definitely some work to do there. And then obviously no major controversies. So, this is really cool as a tool to be able to, now we can look up different ETFs. And we were able to do this before. Again, there is the Morningstar ratings where, I was able to get some of these metrics, and Morningstar has bought Sustainalytics. But the fact that now that I can evaluate ETFs through Morningstar and also evaluate them through MSCI, to me, I'm just like a kid in the candy store here. So, if people wanted to, we could play with this tool a little bit. If there are specific ETFs that you want to see, I know I've been sort of punching in a lot of them that are from the what's it called? My model portfolios. So, if there are specific ETFs, throw them in the chat. Otherwise, just know this is a tool. I'll be referring to this in the future, and this is going to help me, make better decisions in terms of understanding which ETFs are sort of paying a lip service to this versus which ETFs are actually doing sustainable investing, which ones are a lot cleaner. Daryl, anything you want to add to this? Any ETFs that you're keen to look at?
Ones that meet a good ESG threshold or ones that don't?
Well, this is it. I guess we can look at the bad ones or we can look at the good ones. I tend to look at the good ones. Unfortunately, a lot of the new ones, so like the new ones from iShares, like they're not going to be in here yet. That, I do think that it takes probably at least a quarter, for it to be added to the database. So I can't get like the brand new ones, but it's pretty easy to look up something like the Jancy Social Index, and you can see I'm a little bit disappointed here. It's only got a triple B rating. There are some issues here. Carbon footprint on the high side, lots of brown revenues. I think, my issues with the Jancy Social Index are well documented, that it doesn't account for climate change in the way that I would want it to. But, it does a good job of screening out, tobacco, controversial weapons, and any of the major violations. Again, it's going to be interesting to see, like, obviously a lot of these ETFs are now governed by MSCI. Like, MSCI will be in the name because they're going to be the index provider. I would expect those to do better on this MSCI score. Whereas, something like the Jancy Social Index, Jancy was bought by Sustainalytics, which is now bought by Morningstar. So something like the Jancy Social Index, I would expect it to like perform a little bit better through Morningstar's ratings, whereas I would expect the MSCI ones to perform a little bit better through MSCI's ratings. Is that something I should be worried about? These like conflicts of interest and things like that?
I think there's something to note. I mean, for us kind of finance nerds like digging around, these corporate relations in the background and the methodologies is something of interest. But at the end of the day, I think any of the rating companies, they have got to maintain at least the perception of having some kind of integrity in there. So,
Right.
I think that they in the near term there might be some kind of issues as they get their methodologies sort of smoothed out. But longer term, they do need to have some sort of client facing perception that what they're doing is true to form, and that they're
Right.
not just kind of half-assing it. I think the industry has
Sure.
gone through plenty of phases where they've greenwashed things, and you've seen it firsthand from even when you first started good investing and the sustainable economy. Like you saw that stuff firsthand, and gradually it just ends up being a waste of time, I think, for any of these companies who are claiming to have a product that just doesn't add up.
Awesome. Yeah, I think you're spot on there. I think you're spot on there. There was an issue with the chat, so I was able to fix it. Thank you, Wilson, who kind of told me on the side here. So I figured out how last time there was an issue with YouTube in the chat. So I just kind of reset that. But that means there are a couple questions from the chat for us to go through here. So it will take us back just a little bit to the bond part of the conversation. So first question, is there a difference in taxation of GIC versus bonds in non-registered accounts? So first, fully clarify, Daryl and I are not accountants on this, so speak to your accountant and your tax expert, but I think we both kind of know the general rules around this. My understanding is the interest rate is going to be taxed at the same rate. Whereas, with bonds, the issue is that the price will move a little bit. So when you sell it, in addition to the interest rates, the bonds will be subject to capital gains if it's up or capital losses if it's down, which really over long term with these bond ETFs, it's a bit of a coin toss. Like, it depends on interest rates, whether it'll be up or down. So, and I don't expect it to be up or down by a huge amount. Like 5.5% up this year is like a big move for a bond ETF. So, really, I would say that the tax treatment is going to be very similar, especially as it relates to the interest rate. But bond ETFs will have a little bit of fluctuation that will cause a taxable event when we sell it. Do I have that right, Daryl?
That's right. And the one thing I do want to caution some people who, this comes up a lot of times in dealing with clients and having bonds in non-registered portfolios. There's kind of a groan because interest income doesn't get preferential tax treatment. There's been a trend to moving towards product, and I know we haven't talked about preferred shares, but just for to kind of fully answer the question, I would not consider something like preferred shares or dividend paying stocks, even though they get preferential tax treatment, which is great. I would not consider those as substitutes for bonds in your portfolio. So it does kind of suck. Yeah, I think your description of the tax treatment is bang on. Interest income is simply added to your income for the year, and you don't get kind of any dividend tax credit. You don't get any capital gains, with the exception of buying and selling. Just remember that, but also keep in mind that there's a huge safety element to holding bonds in your portfolio, including your non-registered portfolio. With that, just don't get replicated anywhere else by any other type of product.
And just to give, I wonder if I can find Royal Bank preferred shares. I wouldn't even know how to look it up.
ry.pr. And then they've got
ry.pr. Oh, it's not coming up on Google. Maybe I have to look it up on Morningstar or something like that. ry.pr.
They probably issue about 30 different series.
Okay. Oh, right. Because these are all going to be these weird, preferred shares, and at 4.5% or 4.45. So, oops. And that if we looked at these, Morningstar did not like that. Let me try it again. ry.pr. And I'm just going to click on the first one that pops up. That if we can get it, that it would. Now, I can't get a chart in the same way, but let me see here over the 3 months. It does see that it's quite flat. So they've actually done okay. They've sort of held their own through this. But what these are going to do is these are going to be dividends instead of interest. Why they are sort of more considered, more tax optimal. The issue is that they're dividends, not interest payment. So if a company decides to cut their dividend, that this will get cut and that these shares could be worth less. Whereas with the bonds, that's not going to be the case. Is that right?
Yeah, and the other issue with preferred shares is that a lot of them are of the type that are called rate reset preferred shares. And so
Right.
in payment fluctuates with the prevailing interest rates. Usually the reference is the Government of Canada 5-year bond. So basically these preferred shares get issued at a certain interest rate. Every 5 years that resets. Now the Government of Canada bond is yielding 0.2%.
Right.
The interest rate ends up being 0.2% plus a fixed spread. And bleh. What that means is basically it ends up being 0.2% plus maybe 200 basis points. It means that in 5 years, your interest payment from your dividend that you're receiving from that bond could be, like 2.2%. And when it was issued, it might have been 4.5% or 5%.
So whatever, it's not like, again, like an interest rate where or we can expect that that's what you're going to get. There's going to be a lot more volatility there. Okay, cool.
So, yeah.
Awesome. Okay, so question from Mel D. I heard the City of Toronto release some kind of green bond or social debenture recently. How does one go about buying these? The city's contact and my financial institution didn't help. Why am I not surprised? So, okay, these are green bonds. Toronto does have a green bond program. They call it the Green Debenture Program. A debenture is just like a type of bond. It's a fancy word for bond. So from there, these are really cool. There have been a bunch of these green bonds. This is a trend that I love. Ontario has probably done the biggest green bonds that I've seen, where, it has been, I think, $500 million or $1 billion. They've done a bunch of them. Yeah, they've done 7 issues totaling $5.25 billion, which is phenomenal. Unfortunately, we don't get to buy these. That these things get like snapped up right away. So to buy an actual bond, you need access to a bond desk, a bond trading desk. And that, really those are going to be institutional investors, big firms. If you had $1 million and, you were working with an advisor that had access to a bond trading desk, they might be able to go out of their way and buy one of these for you. That said, the rest of us sort of plebes do not get access to these big bonds. So it's kind of unfortunate. I've been pushing, like my big thing has been, whether it's the city or the province or the country or whatever, give us like a retail bond, give us like an Ontario savings bond, that I can buy for like $500 or $1,000. That's like a victory bond, like in the wartime. Like I've been begging policymakers for this. The issue is the paperwork. That, it's way easier for them just to do it through the standard, bond desk where they just issue it. And these do tend to get snapped up very quickly by institutional and international investors. So a lot of European funds are way further ahead than we are here in Canada. And they're just like hotcakes buying these things and snapping them all up before we do. So the province is like, well, we don't really need to issue this retail, even though it would be engagement and even though it would like let people feel that they are part of this green transition and can support the province in that way. There's a lot of demand for it, but unfortunately we're left with groups like SolarShare, co-ops and co-power, really these smaller organizations that are more retail focused. Unfortunately, we can't buy them. Am I right with that, Daryl? Is there any workaround or any creative thought that you've got about how someone might be able to get their hands on one of these big green bonds?
Directly, it's fairly difficult. Unfortunately, green bonds have sort of turned into a bit of a kind of marketing tool for institutional investors. Like, yes, we own pipelines and the oil sands companies, but look, we bought $500 million in Ontario green bonds. And
right.
There's unfortunately no way to, at this point, there's no interest in really pushing it, kind of more towards the retail level, which I agree would result in a lot more engagement. And I think people would be far more interested in understanding, totally. What these programs are, which are really interesting. It's the province carving out money and saying, well, we're going to use these for initiatives that, that might have an impact on carbon reduction, like transit projects. I think people will be super engaged on that. But, what you end up happening is that, the large desks, which I used to work on, basically snapping them all up. And then at the end of the year, putting in their annual report, hey, We bought green
Yeah,
bonds.
we bought green bonds. Look how awesome we are. And we do have to be careful with green bonds. I've just got an article up here from the Financial Post, but Royal Bank of Canada's green bonds may be used to finance oil and gas companies. That Royal Bank is coming up with their green bond. They did a green bond, and part of that money could go to things like carbon capture, right? Or dare I say, clean coal. So there is a really cool organization called it's climatebonds.net, I believe is the URL. And this is a guy named Sean Kidney. And he's got this climate bonds initiative, which is just so awesome. And he's trying to create these standards and certifications and this taxonomy to be able to get everyone on the same page to really restrict the ability to greenwash these things. There's a big conversation around the taxonomy in Canada for sustainable finance. So this is something that's evolving that we're going to keep our eye on. Mel, what it means is that for now, unfortunately, we're out of luck, that we can only buy the more local ones, when they're available. But this is definitely something we're going to keep our eye on. A question from Colby here is saying, oops, I'm sorry, it's hard for me here. Does that apply as well to market fixed GICs? So market fixed GICs. We're now getting down a bit of a rabbit hole here. But this is a different type of structure for a GIC. Now, I know them, market fixed or market linked is often how I see them. Now, these are GICs that have a bit of a twist on the traditional one, which is that they are tied to the performance of the equity market and that follow an index as well. So what these are going to do is they're going to the original principle and offer the potential for higher returns depending on how a specified market performs over a 3 or 5 year period. Now, what I don't know is is this considered income? Is it the interest rate that is tied? If a market linked GIC and the market that is tracking does well, because the idea here is that you get the upside, but that your downside is protected, that you can't lose money on it, but you just won't make as much. Is that taxed as income or is that a capital gain? Do you know that answer? I'd have to look this up.
I don't know definitively.
Yeah, I'd have to look it up. I don't know off the top of my head. So Kelly, I might have to get back to you on that one. And just because I'm not sure, my instinct is that it is the interest rate is what's linked to the market, meaning that it's paid out as an interest. But I think it also happens at the end of the period, which is why it might end up being taxed as a capital gain. So I don't know that, but if I'm honest with you, I really don't like these market linked GICs. To me, if you want something that's linked to the market, buy the ETF. If you want a GIC, something that's guaranteed, buy a GIC. In my mind, this is something that's trying to be the best of both worlds, and it ends up being neither. It doesn't offer that nice, consistent, stable return that a GIC gives us, and it doesn't give us the full market exposure that a stock market ETF would give us. So in my mind, that's kind of my take on these. I'm not in love with these. I also know that oftentimes there are commissions associated with them where people who work at banks or credit unions will earn a commission by selling you a market-linked GIC where they wouldn't get that commission if they just sold you a regular GIC. So, that's, I would say, part of my bias or skepticism there. Daryl, anything to add about market-linked GICs?
Yeah, I'm the same with you on that boat. I occasionally see them. CIBC used to be a huge fan of market-linked GICs. I tend to see them a lot less nowadays.
Yeah.
So I think that I have seen some of the marketing ramp up around those type of products. But by and large, I'm not a fan of them. You're right. They try to do both and end up being not great at either. You sacrifice a little bit on the upfront interest payment that you're getting on your GIC, and then magically what I've seen from market-linked GIC performance is that you don't end up performing nearly as well or as you believe that you should as the markets start to increase. And so they always have this sort of weird, kind of not really explainable, not great performance over time. Yeah. And they tend to hang out in client portfolios for a really long time, and then people just get fed up and then they just get rid of it because they can't figure out what type of return they're supposed to be expecting.
Right.
When the markets go up, 30 or 40% over any given period of time, and the market-linked GIC is kind of not really doing
Yeah,
much at
you're
all.
only going to capture a small percentage of that
Yeah.
market gain. So again, this combo of, stock ETFs plus bond ETFs, in my mind, is going to be much, much, much superior, where you get the upside exposure, but you're protected for the downside, compared to this market link GIC, which is trying to do the same thing in sort of one product, but in my mind ends up doing neither job as well as I would like it to do. Um, Ashley here, is there any tools that do this rating for individual companies? So yes, in terms of the ESG, and there is a video, Wilson, I don't know if you're able to put the link that we did, which was the MSCI versus Sustainalytics. But in terms of individual companies, there is this msci.com/ESG-ratings where we can look up. And then through Yahoo Finance, I can also use Apple as my example. There is this sustainability tab, and I can get this ESG risk rating. There's a bit of an art to like how to interpret this and how to read them, which is why I would suggest looking at that video where I kind of contrasted them and showed a couple companies to, through each rating system to tell you sort of the strength and weakness. So, I really love having the two systems, MSCI and Sustainalytics, for the individual companies. And what makes me so excited now is that I also have the same thing through for the ETFs themselves. Through Morningstar, I use Sustainalytics and MSCI. So it's kind of fun to me, fun with research, fun with ratings. Cool. So if there are more questions in the chat, just absolutely bring them. Happy to see them. It should be working now. If it's not popping up on mine, then by all means, I can always sort of refresh that chat. From there, I do have some questions that people had sent me ahead of time. So we can just go through those. Perfect. Awesome. Okay. So it looks like the MSCI versus Sustainalytics is in the chat. Fantastic. Okay, great. So let me just then reset this because I didn't see it. So there seems to be a bit of a funny issue with the chat. Here we go. Yeah, it's for whatever reason when I pop it out, it just doesn't always update the way that I want it to. So forgive me, chat, if I'm a little bit behind the curve on this. It's not because I don't love you. It's because YouTube is not refreshing for me. So I can see here, great. Yeah, Meldy, thank you. Sai, if there's ever a petition to make these retail, I'll sign it. Yeah, me too. I'll keep my eyes out for you. That would be super cool. I've got someone here, BSOSEJ, just joining now. Seriously focused on ethical investing. Can I choose which index stocks I want and opt out of the index stocks I don't want, like JP Morgan? Probably finding conflicting information about this, I'm guessing. So you're not able to like customize your own ETF. Unfortunately, they kind of come as a package. I've seen some people try to get like really fancy and buy an ETF and then like short the things that they don't want, which is effectively like taking it out of the portfolio. But, I wouldn't suggest doing that. I don't like that strategy. I would just say, really kind of, take it. It is what it is. If it's got JP Morgan in there and JP Morgan is just a hard no, there are probably other things in there you don't want. Find a better ETF for you. So, really now there are such a wide range of these ethical ETFs that, my dream is that you'll just simply find the ETFs that just do align with your values. And that's why I'm so happy to see the breadth of options available. But, there's really no way to customize it. I wish there was, but unfortunately, you're out of luck there. Okay, let me just go to my emails so we can get through these, I think, fairly quick. I've got like 2 questions there. Okay, hold on. Let me see here. Do you see the drop-down option that says top chat? Make that live chat. Oh, here we go. Thank you, Wilson. Appreciate that. Oh, here we go. Now I'm getting all of the questions. Okay, fantastic. Sorry, I blamed YouTube when it was actually a setting that I had. Gail asks, in 2008, the rating agencies were rating some junk as gold. Do we trust them today? Oh, that is a good question. I mean, I trust them about as far as I can throw them, which is not very far for these huge institutions. Really, to me, it's tough. I guess here's what I'll say. I trust them to do their job as they see their job. And the way they see their job is to manage the financial risks that are present within these bonds. And I think they do a really good job as like actuaries of like doing the math and looking at the assets and the liabilities and looking at those very much financial factors. Where I don't trust them on the bond rating side is the ESG risk. So to me, it is very much about, putting my own lens on top of that. Now, that said, there are conflicts of interest, and I think what you're speaking to is this notion that, they often get paid by the companies that they are rating. And Daryl, I see you nodding. So I imagine this is a frustration for you.
Did you tell people I worked at a rating agency?
So let's just touch on that a little bit. What was your experience at the rating agency like?
Yeah, it's complicated. So we absolutely do get paid by the issuers. A lot of people had an issue with, well, how can you maintain some sense of objectivity? And there are definitely rating agencies out there that really did not at all. And so, they really paid a price coming out of it where people had, very little or zero trust in them. They're like, how could you properly rate something when the issuer is paying you? So that was, the first issue that I think that they had back then. They always will have, just in terms of why that is the case. There's a lot of kind of complicated market reasons. But that is sort of like the standard scenario. The thing that I think is really important coming out of the credit crisis, that there are two kind of types of ratings out there, not to sort of jump into like all the details, but the thing that really caused a problem in the credit crisis were ratings on what are called structured products. They weren't ratings really that were relating to corporations. So the ratings for like your Royal Banks or your JP Morgans or your Apples or whoever, the actual functioning corporations, those weren't an issue. The issues were the structured products, which are actually groups of mortgages that are packaged, repackaged, sliced and diced by lawyers, and they use models to basically try and forecast and come up with a default risk. And take that default risk and basically say, well, that's comparable to this type of company, like to an actual operating company that has employees and assets and goodwill and whatnot.
Yeah.
They tried to do that with the structured products, and those models all failed because we had a situation where home prices across the entire world basically kind of collapsed at the same time. So can you trust the rating agencies? You probably shouldn't trust any kind of rating, I would say, out there, whether it's an equity analyst or a fixed income analyst or anything. I mean, there's just that I think helpful piece. I wouldn't go in, to any sort of situation saying, I trust this or I don't, but understand the methodology behind what they're doing. I think, Tim, you raised a really good point that, from a ratings rating agency at the time, when I was doing ratings on your Enbridges or your TransCanadas or whoever, are you looking at things like climate risk? Yes. How do you incorporate that into a rating, and how do you adjust it, over time, over this time span that a company might operate, which could be decades. It's a challenge, and I think rating agencies, much like the rest of the financial services industry, were have been very slow to recognize that. They are, I think, doing a better job of that now, but I think are still very slow. So I think your point of view, Tim, is really good on that. Is to use your own, ratings approach to layer into what information is out there.
Yeah, and what I'm really hearing from you is differentiating from rating, the companies and the governments compared to these sort of structured products, which is a really weird term to just, these bundles, this sort of financial innovation, where there are these funds out there that, are bundled and packaged and sold largely to institutional investors. We're not going to be buying these things. It's unlikely that a DIY investor was, buying mortgage-backed securities. So as long as we're sticking to sort of the standard stock ETFs, bond ETFs, like traditional products, we're not getting into, a lot of these sort of structured and innovative products, then we can probably trust them a little bit more. So I really appreciate that. There was a follow-up question from this BSOSEJ, just asking about basically resource, Canadian starter resources. So what books, online resources, etc. do you recommend for beginners? Most information is US based, Canadian based resources, please. So Daryl, I see you smiling. Let me go through my list of resources. And I think this would be a great little YouTube clip, which is, how do you get started? What is the starting point when it comes to Canadian investors that are just getting in the space? And, what I'll start by saying is that on the ethical side, the ESG side, I think it's important to first start with knowledge of basic financial literacy and then layer on the ethical sustainability side. So my favorite resources, if you're just getting started, is number one is always going to be the Wealthy Barber. Now, this isn't necessarily about investing. This is, very much a common sense, really simple financial planning rules, all the basics. He does it in a way that's very, storytelling, very easy to digest, and a little bit sort of funny and cheesy. To me, this is a really, really easy way to start. This is like the common, one of the oldest books in Canada that really dealt with this idea of financial literacy. There is the Wealthy Barber Returns, which I like, which I think is a little bit more sort of, it's not so much a story, it's these little sort of rules and general rules, but again, written in a way that's very accessible. So that to me is number one. From there, I would sort of upgrade you to Shannon Lee Simmons. That, I think that her stuff is just phenomenal. Again, this is not so much investing. This will get into investing basics. But this is going to be her books around, where are they? Here we are. She's got Worry-Free Money and Living Debt-Free. These are two books that I think are absolutely phenomenal. That again, starting point, budgeting, cash flow, the emotions and the anxiety around this. From there, once you have this basic financial knowledge and the literacy, I think this is really good to wrap your head around. Then my go-to resource tends to be the Millionaire Teacher. And this to me is really a guy named Andrew Hallam, which to me is just brilliant. He calls it the 9 Rules of Wealth. Where is it? Oh, does he have it? Yeah, the 9 Rules of Wealth. And I'm going to Amazon here just because it's like the top link. Support your local bookstore if you can. See. But really, this book, Millionaire Teacher, Andrew Hallam is just brilliant. And to me, this now gets into investing and really understanding ETFs and diversification and all that fun stuff. He did a really cool book, which is a little bit of my Bible, which is Millionaire Teacher for Expats. Where is it? Millionaire Teacher, and then if I do it, expats. So this is a guide for people who want to leave Canada, and if you want to like retire in a place where the cost of living is a lot lower, how to build wealth living overseas. And so this is for like Canadians who want to live somewhere else. So these are like incredible guides, incredible books. And then the last thing that for me is a really good one is Larry Bates' Beat the Banks. And this is kind of to me the book that is all about, why banks are ripping you off with mutual fund fees. And this is, the guide to ETFs. It's a short read. It's very simple, but he does a great job of just really kind of like, knocking out why mutual funds are so bad. He's got this thing called the T-Rex score, which shows you, it like does the math for you to see how much of the money you're gonna keep. So if I'm investing 10K, I'm earning 6.4 annual return. If my fees are 1.75, let's knock it up. What's the average? Like 2.25, Daryl? Like 2.25% over 25 years. I'm going to update it that the T-Rex score is 47%, that the bank is going to keep 47% of my money. That after 27 years, based on these assumptions, instead of having, 37K, I'm only going to have, I'm only going to have 17K. So actually the banks are going to keep more than half of my money in that scenario. So if we can lower your fees down to, let's call it 0.5%, which is a reasonable update for ETFs, all of a sudden now we'll still have that 37K, but we're actually going to keep about 32K. So to me, this is kind of like the next level stuff. From there, really other resources on the ESG side, it really is going to be me and my stuff. And I wish I had like a beginner's guide, but I don't. Maybe that's something I can build in the future. From there, it's going to be, go to my blog, sustainableeconomist.com. I would say there are some great bloggers. Justin Bender is great, Canadian portfolio manager. Canadian couch potato, Dan Bartolotti. They're going to be on the traditional side. And what I've done with my model portfolios is like stolen their ideas and really turned them into sustainable or ethical investing. So, really this would be it. In terms of video or resources, YouTube, I really do like Jessica Morehouse. She does some great YouTube stuff, so she's going to have, about general stuff. More mouse, more house. That she's got some really, really cool stuff. She's got a podcast, she's got YouTube videos. I would say about investing, Canadian taxes, she's just phenomenal, communicates things in a really, really good way. Daryl, any other resources like for beginners that you normally point people towards?
I really like The Value of Simple.
Nice.
It's John Robertson.
Yeah.
And it's a nice, compact,
absolutely
easy to read guide on investing. And it really is what it says. It is a simple approach to investing, which I think just as an industry and as a practice, it gets just sort of totally clouded over with jargon and acronyms and shouting and predictions and all kinds of crap. This book is fantastic at just simplifying things down and giving you just sort of a safe space to get the wheels rolling. Once you get rolling, I think with investing and understanding, keeping it simple is actually a really good way to go.
Yeah.
There's a lot of opportunity for learning. So I think this is a really good guide for anyone starting out.
Amazing. I think this is going to be great. Did ask about crypto. I'm not going to touch that with the 10-foot pole. Crypto, I'm not going to go there. Personally, my issue is just that there's still so much about it that's still kind of the Wild West. So to me, the vast majority of my clients, I'll speak for myself, I have not filled up my RSP and my TFSA. So, I can't tax shelter any crypto investments. So I'm not even going to touch that until my RSP and TFSA are full with sort of more traditional investments. At that point, I might have some mad money that, carve out a little bit of it for some cryptocurrencies. But, to me, that is a huge topic. So I'm not going to go too deep there. Let's get to the questions from here because we're already at 90 minutes. So I'm feeling a little tired here. Daryl, you've been such a trooper. Thanks for staying with us. But let's get to these. I've got 2 questions that I do want to address from viewers. So let's do those and then maybe we can call it a night. So this is from Drew. I'm trying to match my equity as close to the MSCI, ACWI, the All Country World Index as possible by sector. Great strategy there. How close is an acceptable margin of error? I.e., how much is it okay to overweight or underweight a sector when choosing an ETF and its percentage? So this is going to be a place where it really is so much more of an art than it is a science. And as sustainable investors, that's why, we are making a decision here that we're okay deviating from the standard benchmark, right? We're cutting out sectors like energy. We're cutting out things like tobacco or military, so by definition, we are going to start to deviate there. In terms of an acceptable margin, what I tend to do, and Daryl, I'm so curious if you've got a rule here, but, I would say in the ballpark of like 10 to 20% of that percentage. So it's hard when we're talking about percentage of percentages. So let me just I'm going to bring up on my screen the breakdown I did. I did this for you guys a little while ago where I broke down the new iShares ETFs, right? So there's the 3 iShares ETFs, the Canadian one, the US one, and the EAFE one. And that they have different sectors. And so I did like 15% for Canada, 50% for the US, 35% for Europe, Australia, and the Far East. And I compared the sector breakdowns to the iShares MSCI All Country ETF. So I did the same exercise that you did. And when we look at tech, so right now, tech is at 27% in the sustainable ETFs, but only 19% when it comes to the All Country World Index. So this is one that I flagged as overweight because if I take that all country world index benchmark and I multiply it by, let's say, 20%, 0.2, that says that I would be okay if it deviated by 4%. So instead of 19%, if it went up to 23%, or if it went down to like 15%, I would kind of have no issues with that. I would be okay within that range. But the fact that it's gone more than that is why it has become a bit of a flag. For financials, I can do the same formula. Now it's 16.5% in the sustainable ETFs and about 14.7% in the standard all country world index. So, a 20% of the benchmark, it's going to be about 3%. So from 14.71, if it went up to 17.71, I would be okay with that. This one to me is within the range. And what I can do is go through sector by sector and come up with, what I would call an acceptable deviation at sort of 20% of the benchmark's weight, right? So that to me would be, the guideline that I kind of used as I was evaluating it. Now you can see that something like real estate, 3% in the benchmark, 4.25% in the sustainable ones, 4% of 3% is going to be 0.6. So this is a little bit above. So as the numbers get smaller, it gets a little more nitpicky, right? And so again, feel free to use your judgment when it comes to this, knowing that we're never going to get perfect. But I would say that this sort of 20% of the benchmark, higher or lower, would sort of be how I would evaluate whether it's a red flag. Daryl, I see you nodding. Do you feel that that's a sort of acceptable methodology there?
Yeah, and honestly, I have a wide range of sort of feelings on how people should go about this, because I think especially with people who we talk to who are focused on ESG and values alignment, their sector allocations are they're going to be off. They're not going to look like the benchmark, because the benchmark includes stuff that they don't want to invest in. But yeah, it's kind of a philosophical question. It should be, what is your personal benchmark, right? And I think for people who are creating portfolios that might exclude certain sectors, you're going to end up with situations where you might have, significantly overweight in real estate, or tech is the very common one that we see. Yeah. Just be aware of that. And understand, what the risks are in doing so. So, yeah, if you have a portfolio that's, 45% tech companies, which we've seen, I used to see that all the time in the tech run up and kind of the last couple of years. People just need to be aware of that and understand that, they've got a significant concentration and probably only a handful of companies, your Apple, Google, Facebook, and Netflix. And Amazon, I'm not going to forget them. So I don't really have a rule. Okay. When I do portfolio reviews for clients, I'll flag something that is 10 percentage points away from the ACWY.
And is that an absolute term, or is that in a relative, like 10% of the benchmark, or are you looking at flat out 10% above or below?
It's percentage points.
Okay.
So there's a lot of...
So you do give it a very wide range.
It's wide.
Something that's at 13%, or sorry, something that's at 3%, you wouldn't bat an eye too much if it was at 4%, 5%, 6%, 7%, that really once it gets above 13%, that's when you're like, whoa, wait a minute.
Yeah.
It's cool.
Flagged. Yeah, it's flagged. It's not a no.
It's not a no, right.
It's not a no, but any of these sort of rules or any of sort of these restrictions, I firstly think that they're super helpful to have in place. The discipline is helpful no matter what methodology you use. So have one, and then stick with it. So, cool. If you feel like, if you're double or half the benchmark in terms of your weighting towards a sector, if that's your rule to start, which I think is reasonable, use
okay
it,
with that.
With it. And, I don't think it should ever be really a hard and fast, no. Yeah. It should just trigger a sort of review, I think, totally. by the individual. So,
and I would agree that, in my mind, this is kind of low down, on my list of priorities, right? That, to me, I don't want you to make a portfolio that's many times more complex than it needs to be. in order to get your sector allocation right where we want it to be. I wouldn't want you, playing with the portfolio weights and going way overweight, Canada or US or, a region of the world in order to get that sector weight appropriate. So to me, like keeping it simple, keeping the fees low, and to me, the geographic diversification would sort of all be higher on my list of priorities. And then below that would be the sector diversification, that it's still an important thing to look at. And sure, yeah, to get it close to the benchmark is good. And if you're struggling about, how much should I do or where am I at or under, but that, you're never going to get it exactly spot on. So to me, this would be lower on the risk of priorities.
Yeah. Number one in terms of what your return is going to be comprised of is your asset allocation.
That's right.
Is
so percentage of stocks versus bonds is
Yeah.
by far and away the biggest decision that you make.
Yeah.
And then from there, everything else really is sort of brushstrokes, is the artist's interpretation. That in terms of the country weighting, we've talked about this idea of the home bias in the past. And I know we've done a little video on the home bias, or I don't know if we did the video there, but we certainly talked about it. And that really that first it's percentage stocks and bonds, then I would say it's geographic breakdown in my mind, and then it's going to be sector breakdown, sort of in that order. As long as you do have some exposure to everything, like obviously if you had like no tech, but your geographic allocation was spot on, that to me would be a bit of a red flag. But generally speaking, especially if we're just talking about the sector weightings being off a little bit, to me that is a fairly low priority compared to the other factors. Cool. So let's do one more question. Okay, this is a question from Rick. We talked about impact investments in the past, and I've brought up this idea of accredited investors. And this kind of speaks to the green bond thing a little bit, just because, accredited investors are really sort of, able to buy a lot more things than us plain old retail or even qualified investors. So in terms of the rationale behind accredited investors, let me just bring up the actual definition in Canada, just so that people do know that we're very, very clear about what it is. Here, what's a good link for this? Okay, Startup Here Toronto. I think this will be, oh no, does it give it? Here we go. So there are two different ways that you can do it, either by your income or your financial assets. If we're doing it by income, your net income, right? So if you own a business, this is after you've paid all your expenses, exceeded 200K in both of the last 2 years. So you earn 200K each year for the last 2 years, and you expect to maintain the same level of income. Or if you're in a household, right, then your net income before taxes, so again, net income, so this could be your salary, if you want to see it that way. Or for me, I always think of the entrepreneur, this is going to be, basically what you're reporting, the high level income you're reporting on your taxes. So for me, that would be after my business expenses. Combined with a spouse, if we exceed 300K as a household for each of the last 2 years and expect to maintain it. So really, high levels of income, either for yourself or as the household. The other way to do it is through financial assets. So financial assets, these are going to be liquid assets. So these are going to be like stocks, bonds, ETFs, the types of investments we're looking at, worth more than $1 million before taxes, but net of related liabilities. So you can't borrow money to get yourself over that $1 million mark, but $1 million in liquid assets. The last thing is net assets, which really does include your home. So that $1 million, that can't be your house. That has to be like liquid investments. Or if you want to count your house, you can do that, but then it's $5 million. And again, this is as a household, net assets of at least $5 million. So the idea here is that, really this is rich people. And they're doing this based on either your income or the assets that you have. And the idea here is that you have so much money that you can afford to take more risk. And it's not going to be a problem if part of this investment goes to zero and you lose all of it. So part of it, I think the rules around this, why a lot of these impact investments are only available to accredited investors, is that really they're trying to protect the like little old grannies, who are living off their income, who, someone convinces them to buy a very risky asset that's not a standard, stock bond thing. Some of these, what did we call them, structured products, I think are available to accredited investors only, right? And I think part of the assumption is that you can afford to lose it. I think implicit in this also is part of the assumption that if you're rich, that you have more financial literacy, that you're going to be better able to understand the risks and do that due diligence, or better yet, you can afford to hire someone to be able to do that risk analysis and that due diligence before you invest in these things. So, really what this means is that, investments that are only available to accredited investors, really the rationale behind it is that A, you've got money to lose, so you can take more risk, and if you lose it, it's not a big deal. And B, you're either going to have a little bit more knowledge, or you can hire someone with more knowledge to help you evaluate the risks. Because really, if it is available to accredited investors only, what that means is that it's not your typical investment product. It's not going to be a straightforward thing. It's going to be riskier. It might be something like private equity or venture capital, or it might be, one of these structured projects like these, credit default swaps, or, whatever it is, that really it is going to be riskier and it is going to be more complex. Therefore, this is something that the government and the Ontario Securities Commission has put into place to make sure that you've got enough money that there's a reasonable assumption that you can handle that level of risk. Did I get that right, Daryl?
Yeah, absolutely. And I think one other thing I'd point out too as well too is some of these deals that come to market sometimes, and I don't want people to think that accredited investments are of any kind of lower quality or higher risk all the time. Sometimes deals come in, the issuers just don't want to do the paperwork. They don't want to pay the lawyers to go through all of the registration requirements.
Totally.
They can sometimes meet with large investors, high net worth investors,
right.
People who represent those individuals. And when you do these type of more private deals, you save lots of money through not having to pay lawyers.
Yeah.
By comparison to more broadly marketing deals. So.
Right.
Hopefully that won't always be the case. It is definitely the case right now, where there's more opportunities for certain households. But I think the nice thing that we are seeing is that the diversity in terms of the deals that you're able to see in both mutual funds or exchange traded funds or in individual stocks. I think that has improved markedly over the last decade. Really,
yeah.
like the regular investor has access to. I think companies, investment strategies, products, lots of things that they didn't have access to a number of years ago. So totally. That's a really, really good thing.
Lots of innovation in this space. I'm a big fan of this model of equity-based crowdfunding. So something like Front Funder, which, really these are new regulations, that came up just a few years ago that have allowed non-accredited investors, so regular people like you and I, to be able to do some of this riskier, venture capital things, minimum investment, 10K, 6K, $1,000 here. So, this is going to be a lot more like, this is like Menzil's Halal Mortgage Fund. So if you wanted to do halal investing, but mortgages, it's tricky. You can't do debt. So this is structured in a way that is sort of, Sharia compliant and, available for a minimum investment of $1,000. That for a long time, this really only would have been available to millionaires. And so now it is opening up. So maybe we can do a little look at something like equity-based crowdfunding in the future, if there's interest in looking at those. I know someone had asked, I think it was Ayeta had asked me about peer-to-peer lending. So maybe that's something that we can look at. That would kind of fall under this as well. So, okay, I think that's it for tonight. I'm getting a lot of thank yous in the chat. Lots of great information. I did get asked for intermediate advanced resources. I mean, honestly, beyond that, I don't, I would say that that if you're looking for those advanced resources, they're out there. You know, I'm not going to get into, you know, training strategies or anything like that. So really the value of simple and the you know, the millionaire teacher, you know, in my mind, that's all you really need to know, that it doesn't get more advanced than that. And certainly if you wanted to go into, like, you know, day trading strategies, I'm not the person to help you out there. So I think I'm happy to leave it there. Yeah, a lot of people saying, you know, thanks so much, Tim and Daryl. Lots of great information. Thanks. This was a great open window and very informative. So Lauren, Gail, Ronald, thank you so much for watching all the way through. If you're watching this on YouTube and you've watched this like entire episode, then do me a favor, click on the like button, you know, subscribe for it, help me out with those YouTube algorithms and robots is very much appreciated. Daryl, thank you so much for taking a Thursday evening and joining with us. I really want you to come back in the future. So I hope you had enough fun that I'll be able to rope you back in again. I know that you were able to bring a great perspective that brought a lot of value to people. So thank you so much to you and for everyone for watching, and have a great night.
Have a great night. We'll talk to you guys soon.
All right, so ended it